Hey everyone, I'm Cary Smith and I'm sitting here with Amar Shah. And Amar and I are both with Client First Capital. And Amar, today I think we have a great topic. It's what to do if you're behind on retirement savings as an executive. And there's some differences for executives, which is why, we're calling that out specifically. One, they have, in most cases or in many cases, higher earning potential. And in that role, a lot of times employers are giving them tools to help them be successful. But we do find that not everyone's taking advantage of all those tools and all the things that they can do. So if you find that or you're feeling that you're a little bit behind on retirement savings, you're not alone. However, there are some actions that you can take.
Yeah. It's kind of funny when we think about this and you think, personally, if you look at yourself and you say, I'm an executive, how can I be behind? Well, the truth of the matter is that your savings relative to your spending really determines if you're on track or behind or above track. I've met a lot of individuals that have saved, 1 million to 2 million set aside that have more than enough money for their entire life. And then I've met individuals that have saved 10 to 20 million that are going to run out of money,
Yeah.
right? And so one of the surprising things, for high income earners is that the lifestyle inflation and investment missteps have a huge impact on their ability to retire, right?
That's right.
So I think the first step in this is to assess where you stand, right? Because beyond salary, you have to consider your stock options, RSUs. Sometimes you have a pension associated to like a director level or above. And sometimes you could have business ownership in terms of equity and stake, right? And
I was just going to add, a lot of times, just that first step of stopping and assessing where you are, even if your assessment is you've got a lot of catch up to do, typically people start to feel a little bit better once they take that step and they at least are facing it and begin the process, right? So just
right,
that step alone, I think will help people feel better about the process.
yeah. I'd also say that helping you assess where you stand with a financial partner, like a financial planner, is a
Mhm.
good place to start because they can also give you an independent third party perspective on your situation, right? And that leads us to number two is really to focus on the things that you can control, right? And what I found is with tech entrepreneurs and business owners, um, especially for individuals that are connected to social media and all these other things, you know, you get this idea of lifestyle and retirement that may not be your reality, right? And so we want to kind of prioritize for you what are the high impact experiences that you want to have that are aligned with your values, and to also align that with your financial plan, budget, and withdrawal strategy from your portfolio.
Yeah, very good. So maybe one of the things we talk about is, um, are you maximizing your contributions? So there's 401k, or IRAs, there's HSAs, and there may be other, deferred bonuses and things of that nature that people can select. So let's talk a little bit about, just ensuring that we're maximizing all the savings tools that we can.
Yeah. If you're an executive at a big firm, I think one of the things to consider is that what is the max that you can contribute to a 401k, right? And so a lot of people think that's the IRS limit for the employee contribution, which this year is 23.5 plus there's a catch-up provision if you're above 50, and they're including a new catch-up provision if you're above 62, right? And so that is not the max that you can contribute. There are really three different items that the IRS looks at. So for 2024, that number was 69,000. 2025 at 70,000. Those three items are the employee contribution, employer contribution, and any after-tax contributions, right? So you could use your 401k plan to put in the pre-tax bucket, get some matching, but then also put money, whatever gap you have, in that after-tax bucket and do Roth conversions of those dollars. And that's really gets you to this mega backdoor Roth IRA, right? Is really to make sure that you're maximizing that higher threshold rather than the IRS employee max of 23.5. There's also HSAs, other retirement accounts that you may have access to, your deferred comp, understanding the liquidity risk within the deferred comp or the time period that you have. Some deferred comps pay over a 10-year time period and they have separate tranches. Some just pay out as a lump sum. So you get all these deferred comp credits, if you will, and then you take your total credits and then you have 10 years to distribute that all at once, right? So every company is different, really looking at your company plans. And then I would also consider that as an executive, your current income is coming from your company. You probably have a high concentration of company stock, right? So you have your current income, your future income, and also your past income in that company stock. That may be a little bit too much risk into having that concentration. Or it may be if you're at the time of retirement or if you're above 55, you can do a net unrealized asset transfer and help diversify that stock in a tax efficient manner, right? So,
Yeah, very good. So also, investing and managing those assets or having them managed, right, is important as well. And we see, we meet with clients who, either, their strategy has been, hey, I'm just putting a bunch away, but I'm really not actively managing it or watching it or know how much risk, or am I too risky, not risky enough? So let's talk a little bit about to invest wisely for growth.
yeah, I mean, I think if we're talking about a perspective, if you're behind,
Mm-hmm.
uh, it, just because you're behind doesn't mean you have to be you have to be conservative with your investments to make sure that you have them when you're ready to retire, right?
Right.
You have to plan for your whole retirement, which could be 20 plus years in retirement. The other thing that I would say is that the amount of risk that you're taking is you probably want to diversify away from your company's industry, right? And how that the correlations of those different investments. Also, as you're an executive, you probably get pitched a lot of private equity, venture funds, uh, things that sound sexy, but could 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 really create more risk to your overall retirement planning than if you were like in your mid to late 30s to 40s to really having that time horizon for those type of investments. Really
Sure.
looking at just looking at growth, looking at inflation, just having a good plan that's rules based will probably get you to where you need to be.
Yeah. So, earlier you mentioned that, spending is a big part of the equation as well.
Yeah.
And so maybe we should talk about, lifestyle and, and things that a person can do to make sure that they're spending smartly and they're lowering their expenses, to help them as they prepare and try to catch up.
Yeah, I mean, I think Cary, you got this one because Cary, being humble, is not saying that he's been an executive at USAA for many years, and I'm sure you've seen executives that had a very conservative lifestyle, and you've seen executives that spend a lot, as well as younger executives that that are newly getting into that and trying to, I don't want to say fit in with the Joneses or keep up with the Joneses, but there is a little of that. Is there? Isn't there?
I think there is, Amar. Yes. So I did retire from a large corporation as an executive, and it was in the financial services industry. And even in that industry, I had peers who, some of them were, very savings minded and focused on retirement and started early and did everything right. But I had a close friend that wasn't even contributing to, to get the employer 401k match as an executive, right? And that's breaking the number one rule of don't turn down free money.
Yeah.
And then also I have seen some with lavish lifestyles and 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 just hard to support long term, and still make sure that you're saving for retirement. Because also by the time a lot of these people make executive, they have the other financial pressures of kids are getting closer to the age for college, right? And so there's savings there. Sometimes there's parents or other family members that are needing support, and
Family generation. Yeah.
yeah, and you start thinking about your own long-term care and those insurance costs and so forth. And so you start getting a lot of competing interest. So your spending becomes even more important as you progress.
Yeah. Yeah, and for most executives, and let's maybe make this the last point here, Cary, is
Mhm.
that for most executives, you can't just turn off, right?
Right.
For most executives, their schedule has been packed with meetings and conferences, etc. That there's also an emotional quotient to actually retiring, right? And if
That's
you're
right.
feeling behind on your actual savings, you may find a position as a board member or at work as a consultant and have some level of base income coming in that could supplement your savings and your retirement, right? So that is another way to say maybe working longer, but not as intensely,
That's right.
Yeah. If you like our content, please reach out and hit the like and subscribe button. It helps other people find our videos. We also have a newsletter that we put out once a month, which is found on our website, clientfirstcap.com. Thank you for watching. Thank you, Cary.
Hey, thanks, Amar.
Yep. Bye.